Hi everyone. I am, as Darren said, the portfolio manager at China Merchants Fund. We are a top 10 mutual fund in China under the China Merchants Group. And our parent company is the China Merchants Bank, which some of you may be familiar with because we have a branch in Singapore. And so as for myself, I joined the industry back in 2012. So I have around, 13 years of experience. When I first joined, I was working for a US hedge fund called Pine River, and I was part of the Greater China team, doing a lot of hedge fund strategies like long-short equities, CV arbitrage, event trade, etc. And so I was a trader and a strategist for Pine River. And then I joined another hedge fund after Pine River called Brightway in Hong Kong before coming back to China to China Merchants Fund in 2021. So that's my background. And now I am a PM managing a global allocation fund that invests in global credit and global equities, as well as a Hong Kong portfolio. So invest mainly in Hong Kong names. So those are the two funds that I'm running. And so, with this kind of background, you can expect my presentation not just focusing on China like a lot of the, traditional Chinese PM would do. I also have a global view, more of a comparative analysis between, the global economies and the global markets, to give maybe another aspect into how to look at investment right now into China or, into the rest of the world. Without further ado, I'll first start the presentation because I think right now, instead of just looking at China, I would look globally as well and to do a comparison between China and maybe global assets, especially the US asset. So one of the statement that we've heard a lot right now on the street globally is the end of the US exceptionalism. Uh, that's the word that we've been hearing a lot. And this is how I want to start. So this is a graph of where I think every economy is at the moment. With US, towards the end of a very prosperous long period, but its economy potentially overheating. Um, because the US has been growing in the past, decade, post the actually uh, ever since the financial crisis, maybe for more than a decade. I think its growth has mainly been driven by three main factors. One is software and the AI narrative. The second being a government leverage that helped household and corporate to spend more. And thirdly, a capital account inflow, so money coming from the rest of the world to invest in the US because of its high ROE and because of the fact that the whole world got wealthier because of US companies setting its investments or setting its companies globally, right? The global trade, where the US consumers are buying from the rest of the world, making the whole world richer, and then the whole world have more money, and then they're buying US assets, right? So these three factors: AI narrative, government leverage, and the capital account inflow are what I think is the three main factors that saw the US uh, outperforming the rest of the world for the past decade and more. Um, but right now, what we're seeing is maybe a reverse of these three key factors. And on the other hand, we're seeing economies such as Japan, Europe, and China all at the very bottom of the economy for the past 10 years, and now they're getting out of where they were, the position that they were stuck at. For example, Japan, we've always been talking about 30 years of stagflation, right? And now they're coming into inflation and they're seeing growth, right? And Europe, for the past decade, very slow to turn around. Their growth is diminishing, a lot of long-term issue. But right now, we're seeing them stimulating the economy. We're seeing the ECB lowering their rates. We're seeing confidence, right? And same with China. China, since the COVID, has run into its own issues with the housing market, with its consumption issues. But we saw a change of policy since September 24th last year. And these policies, after 2 quarters, or maybe 3 quarters now, we're seeing some effects, right? It's slow. It's already seeing the economy bottoming out, and we're seeing a lot of structural opportunities within the new consumption space. We're seeing opportunities in the AI space, and most recently in the biotech space, right? So we're seeing a lot of structural opportunities, and also the economy is bottoming out, and hopefully with more policies towards the end of the year, that the economy will be on a better growth trend. So one thing that I use to compare between different countries is to use this term called equity risk premium, which is the difference between the equity return and the risk-free rate. So for the US, it will be the return on the SPX minus the 10-year treasury. For Japan or Germany or for China, it will be, their earnings equity return minus their respective treasury rates, right? And by equity return, I mean the overall earnings of the whole market divided by its market cap. So it's a measure of the relative risk reward between equity and the credit or the risk-free assets. So say for the US, its equity risk premium is right now slightly negative, which means your return on buying a US stock market, buying the SPX, is negative, is less than if you're buying a US 10-year treasury, right? We all know that the 10-year treasury is now about 4.5, 4.6%-ish. So the equity return is around 4.3, 4.4. So it's slightly negative. But the risks are very different, right? The risk of equity, the volatility behind that, and the risk of a treasury, right, with government-backed credit is much lower, and the volatility is supposedly to be lower. But now we're seeing, the return on this risk-free asset is actually potentially higher than that of the equity. Does that make sense, right? That's always a question that I always ask myself. It probably did. It probably did back in the last 2 years when there was a stimulus policy, when AI is on the rise, when we thought, AI is going to change the world. It probably makes sense then. But then after huge dynamic changes, right, when we saw, Donald Trump's policies, when we saw a slowdown in AI, this has changed, right? The narrative behind the asset valuation has changed. And hence, what we're seeing right now is US being expensive and it has a negative catalyst. Whereas China and Europe and Japan and maybe some other economies out there, they were cheap. They were cheap for the past 5 years. They were cheap for the past 10 years. And now they're having positive catalysts. And that's a huge game changer. So going back to, maybe I'll expand a little bit on the three narratives, right? So as I said, the three pillars of US exceptionalism was the AI narrative, the government leverage, and the capital account inflows. Why has these three things changed? Now, back in third quarter last year, I was already looking at, NASDAQ and SPX for my own portfolio. And I saw the AI slowing down because the three key factors of AI, right? Data and the model and the computing power behind it. We saw data-wise, we're feeding all the effective data into the model, and yet the best model that they can come up with was OpenAI 4.5, the ChatGPT 4.5. It was very slow for them, and they still couldn't this day evolve into GPT-5 or GPT-6 because there was not enough effectiveness natural data out there. So what's the next step for OpenAI, right? They introduced the O1 model, which is a reasoning model. It enables the model to think based on existing data to come up with new data, right? So that's what we call a synthetic data. So in order for us to reach the next level in AI, we need synthetic data on top of the existing natural data. But that's a timely process because it takes time to form these synthetic data, and it's expensive. It costs a lot of money to get, data in their billions quantity, right? So it's a slowdown. Now, whenever there is a slowdown in a leading technology, we all know one country thrives in that environment, and that's China, right? Because China has been the number two player in AI. It's been following US very closely. And the moment AI slows down in US, the US has been leading it, right? They've been beating China during the AI innovation part. China's following. The moment the US AI slowed down, what are the Chinese good at? We're good at making applications. We're good at engineering. We are good at, making things cheaper and better and more efficient, right? This is what the Chinese engineers are good at. So once we saw the AI frontline, the innovation side slow down, the Chinese engineers, namely DeepSeek, and Alibaba, right? They took the existing models that they've learned about, and they optimized it and made it cheaper and efficient to run. And that's when the DeepSeek moment happened, right? And that changed the AI narrative of US exceptionism because AI is no longer a US leading thing. You have a competitor that can do things about as good as you are, but at cheaper and a more efficient way, right? So that's the first thing that has changed. The second thing we're talking about is government leverage, right? Since COVID, the US has been throwing the US government has been uh, throwing money to its household, right? What we call helicopter money from Donald Trump. And that gives US consumers, household, a lot of money to spend. And then they've been spending this money ever since, right? And that has been a very strong driver for the US economy. But now the US government is facing two issues, right? It's like a boomerang, right? Back in 2020, Trump and Biden, they threw out the boomerang, and 4 or 5 years later, it came back and strike them, right? Because back then, the US economy was healthy. It has a high growth rate, but a low inflation and a low deficit. So it can throw money out, right? The government can raise money, leverage itself, and dish out the money to corporates and to households. But 5 years later, right now, um, not only they still have a high growth, but they have a high inflation and they have a high deficit ratio. So they cannot play the game anymore of keeping on giving out the money to its households. So the limitation of stimulus, it sees a limitation right now. And thirdly, I think is the biggest changing factor, the capital account inflow under Donald Trump version 2.0 is Donald Trump's MAGA policy. Because as I explained before, right, um, what the US did and why the US dollar was so strong and why globalization was in favor of US assets was because the US, the US corporates, they put a lot of their production facilities into the rest of the world where everything is cheaper and more efficient. And the US consumer, with their US dollars, are buying these products from the rest of the world, right? And that gives US a current account deficit, right? Or what we call a trade deficit, right? The US people are importing a lot of money, importing a lot of goods, but they're not exporting as much. So that's a deficit, a trade deficit. And that's also a current account deficit, right? But they're giving a lot of US dollar to the rest of the world. And everyone else, right? Whether you're in China, whether you're in Europe, whether you're in Singapore, when you receive these dollars and you look at the companies globally and you see, oh wow, the US company, they're doing the best. They have the best ROE. So we're all taking this money and investing in US assets, right? So that's what we call a capital account inflow. But Donald Trump is changing that. He wants production, he wants manufacturing back to the US. And current account and capital account, they're, two sides of a coin, right? So once you decided to import less and you want to bring the manufacturing back to US and you want to export more, your trade deficit shrinks. That means your current account shrinks. And that means you're paying less dollars to the rest of the world. And that will mean eventually a shrinking in capital account. And that means less money from the rest of the world to buy these US assets. So we will potentially see a capital account outflow, and that will lower the asset prices of US assets. And so this is what I mean, right? I think right now, Donald Trump's core economic issue is transforming the three highs that we're seeing right now, high inflation, high deficit, and high growth, into two lows and one high. Low inflation, low deficit, and maintaining a high growth rate, right? So his core policy is to rebuild US manufacturing, his core policy is to reducing budget deficit, and his core policy is to tax cuts and fiscal spending. But those all have impacts, right? And before I get further, I just want to say, because when we want to look at his policies and to look at his impact globally, we need to look at Donald Trump's why he's coming up with these policies, right? And what are his constraints? And what are the potential policies that will be happening in the US before we can then compare that to China, right? So right now, I think different from Donald Trump 1.0, when in his first term, right, it was all traditional MAGA, right? It was simple. Every policy has its direction, and he just wants to get done, and that's easy. But now in Donald Trump 2.0, the forces behind him is more complicated. Not just only he have the traditional mega parties, but he also have the tech mega parties and the geopolitical mega parties, right? Where tech mega party are like tech upstarts, like Silicon Valley elites, like Elon Musk, right? And geopolitical megas are like strategic hawks, right? Like Vance. And so the three parties, they share mutual interests. They all want small government. They all want deregulation. They're all anti-DEI and anti-overly political correctness. They want lower tax burdens. They want to tighten immigration policy. And they are all anti-Wall Street capital manipulation, right? They don't like the traditional financial capitals and the old oligarchs. But uh, they're very different. They have split between immigration tariff and Chinese policies, where the traditional MAGA, who are mostly conservatives, white people in their late 50s, mostly middle and lower level industry workers. They are, in terms of immigration, they're more anti-competition. They want protectionism, right? They're wasps mercy. They want deportation of illegal immigrants. But the tech mega, who are the tech capital upstarts and mainly AI and military people, they're not like anti-all immigration. They're more selective, right? They want they oppose the influx of low-skilled immigrants, of course, but they welcome orderly immigration of global skilled and tech elites. That's what they want. They want these elites to come in. In terms of tariff, traditional mega just want protectionism. They're calling for higher tariff barriers in everything. But the tech mega, they're more orderly, right? They want orderly tariff increase and they want a gradual adjustment of the global supply chain. And when it comes to China, the traditional mega wants total confrontation. They want complete decoupling, whereas the tech megas, they want orderly confrontation. They want to have, in sectors which they are advanced at, they're good at, where they have competitive edge, they want those sectors to be protected against Chinese competition. But, in sectors where, like manufacturing of clothes, etc., where it's like low tech, but high labor intensity, they say, hey, just let China do it, right? Because they can lower the cost for us. So that's what we're there. So you see a confrontation of these three parties in all levels of Donald Trump's main policy space. And that's why you see a lot of back and forth between the policies that Donald Trump has been given out. For example, Harvard, right? We saw, Donald Trump rolling out Harvard, and you'll be like crazy. Why would you want to stop, the US um, getting all the best talents from the rest of the world to come and study? And then after that to stay in US, right? The force behind it is traditional MAGA. But then the tech MAGA don't like it. So, in recent negotiation between Trump and China in London, right? You see him dying down the tone because I'm sure there's people behind it, especially tech guys, saying, "Hey, you can't do that because that's the bread and butter of the tech industry in the US." And for tariff, right? Why Donald Trump put up all the tariff to the rest of the world, 30, 40% in April, right? That was because the Trinity Magel wants that. But why was he so quick to chicken out? Because the other party behind it, they didn't like it, right? And also, we saw the court ruling as well. So there's a lot of internal forces like pulling the rope on two sides and causing a big swing in Trump's policies. And so, when you have all these big swinging policies and you have all these you know, policies that, to the rest of the world, not just to China, but to the rest of the world, you will have effect where the policy sparks a global anti-US sentiment, right? So since Donald Trump took office, we can recall a few things. Like he said, Canada will become the 51st state of the United States. He wants to rename the Gulf of Mexico to Gulf of America. He wants Greenland to be part of the US. And the global tariff policy that came out in April led to significant rise in nationalism globally. So on the right, the FT article, you can see that the number of people flying from Canada and Europe to the US has declined sharply since April. You saw, uh, Canada, which is the backyard of US, the Canadian nationalism on the rise. So there's a landslide victory of Carney, who's labeled as the anti-Trump fighter, right? And therefore, we saw a foreign capital outflow from the US recently. And that's very important because, US asset price has gone up so high. US equities, the standard as the S&P 500 rallied so much was because of a lot of foreign ownership, a foreign money inflow to buy, especially since COVID-19, right? A lot of foreign money came in to buy. Now this trend is changing, and where does this money go? Um, they're going to the rest of the world, right? They're investing into. We saw Europe, we saw Japan, we saw Korea, we saw Taiwan, we saw Hong Kong, we saw China, right? This is where all the money is going. They want to see where things is cheap. As I said, where things is cheap and where there is catalyst. That's what they're looking for, right? So the last slide, of course, to talk about US is right now we will expect increased volatility in the US market and to buy rest of the world where there's catalyst because there's a lot of short-term, medium-term, and long-term um, kind of like factors. Some of them are positive, some of them negative, and they're pulling each other, right? So on the short term, you have, on the positive side, the resilient economic data, you have tariff negotiating settling, you have a very good self-correction system of the US political system. But on the other hand, you see back and forth policy tariffs, right? You see foreign capital outflows. In the medium term, we are worried about a potential downgrade in US credit rating. We're worried about a potential downgrade in corporate earnings. But then in the US, potentially you'll have interest rate cut cycle coming. You will have policy stimulus from Trump, right? And in the long term, we're worried about the downward shift of US asset valuation range due to a foreign capital outflow. But then again, what happens if the US AI technology broke through? What happens if Donald Trump's vision of US manufacturing going back to America, make America great again, actually worked, right? It revitalized US manufacturing. What happens if that happened, right? So all these factors are playing in like a tug of war, and that's causing a lot of volatility in the US market. And therefore, a lot of the money is now shifting to look at the rest of the world, where things are cheap and where there might be catalyst. And that's where things got interesting in China because now a lot of the foreign money that I've talked to, including Singapore money. So I was in Singapore in the first quarter of this year, and I was talking to a lot of, Singapore banks and Singapore insurers. And Singapore is very is strategically positioned in the middle between the West and the East, right? Between US and China. So Singapore investors are more neutral. They don't have the filter goggles, right? When they look at the economy, they wouldn't think, oh, US is so good. They wouldn't think China is so good. They will think, they'll give a very neutral opinion. So it was in Singapore around March that I realized a lot of Singaporean institutional investors in February actually shifted a lot of their assets and put them into Europe and put them into China because they saw this change. Before, a lot of the global investors saw it because Singaporean investors are in the middle, right? They're more neutral. And so what they saw is a relative return of the US to emerging market has reached a historical peak. And they're worried that the US dollar index is also at a historical high. And once we saw the beginning of a downward cycle of the US dollar, then the performance of the MSCI emerging market will outperform. And within that, China accounts for more than a quarter of its weighting. So that means, if money is going out of the US and they are investing into rest of the world, if they're investing into MSCI emerging market, then a good chunk of that money will go into the Chinese assets. And secondly, I think, from a tactical perspective, given the certain uncertainty of the global growth due to US tariffs and other policies, I think the Chinese economy is still under a little bit of pressure, but we're also seeing a lot of structural opportunities, which I will mention later. And maybe in the second half of 2025, I think there will be stimulus policies coming out from China, and that will give Chinese assets more catalysts, and I think more money will move into China, especially Chinese and Hong Kong assets. So, what's the problem and what's the way out for the Chinese assets? I think most importantly, I think is your funding cost is higher than your expected returns of your investment. So due to the weak demand, the low inflation and the weak credit issuance in China, we're seeing a lot of credit contraction or what we call deleveraging. And in this phase, the investment returns of money in China has came off quite a lot, but the financing cost was slow to come down. And right now, I think it doesn't make sense for people to invest in China because the cost of borrowing money is more than 3%, but the investment yield is probably around 1.8 to 2%. So why would you borrow money and invest in China, right? So the government was quick to realize that. And so they know that they need to do two things. One is to do rate cuts to lower the cost of money, to hopefully below, your expected returns so that people will restart borrowing money and to put that into investment. And secondly, you need fiscal intervention, right? And that's what the government is doing right now. So ever since the September 24th of 2024, we saw a big shift in government policy, right? Previously, before that, the government was very tight about spending its money because the government was already back then very worried about Donald Trump 2.0 because in the first presidency of Donald Trump, his policy was to to attack China in every way, right? From trade to policies, etc. And he's having a tariff war with China in his first presidency, right? And that caused a lot of trouble for Chinese companies like Huawei, right? Like ZTE. and to their global operation, right? So the government has been doing two things during the Biden administration. One is to to help a lot of the companies to go overseas. So previously we're exporting, right? We're producing in China and exporting to the US. And that means it makes easy for US government to say, hey, we just stop all the trade or all the goods that are coming out of China. But in the past 4 years, what the government has been doing is that they're letting all the companies to start operations globally, right? We can feel it in Singapore, right? You see a lot of companies, Chinese money coming to Singapore so that they can set up their operation in Indonesia, in Malaysia, in Thailand, in Vietnam, right? And the money is also going to countries like Mexico, right? You know, EU, globally. And we've been setting up operations and manufacturing plants everywhere in the world. And now it makes so difficult for Donald Trump to track which good is coming out of China because we can just export all the raw materials and the parts from China and have them assembled somewhere else, right? Have them assembled in Indonesia, have them assembled in the Philippines, and then we ship out to the US. It's very difficult for the US to track where these are coming from. And that, in my opinion, has led to the tariff policy that came out in April this year, right, where Donald Trump is now, instead of putting tariff just on China, he's putting it on the rest of the world because he thinks they're all coming from China, right? So those are the policies, and I think government has also realized that the second thing that the government has been doing is during the Biden administration is that they're not giving out a lot of money because they want to prepare all the money like a vault to prepare for the real showdown, right? Because they don't want by the time Donald Trump comes in and he starts a second trade war with China, potentially or maybe even potentially a hot war with China, we don't have any money, right? So the government has been very careful with their money. They don't want an economic crisis, and they want to have enough money in their vault, in their treasure vault, so that when the time's needed, they can take out the money and then stimulate the economy at the right time. So the government have been very tight with its fiscal and monetary policies. But in 2024, when the government realized, being too tight means the economy is uh, the growth speed is coming off, and people were not happy, right? And the economy is slowing down, and that's not good for China. So for the first time in 2024, the government says, hey, we need to start stabilize the market. We need to pump more money into the market. We need to cut the rates. We need to stabilize the real estate. So we saw a lot of policies on the real estate side. We saw a lot of policy on like government spending its money to give consumers like rate cuts, right? It's like consumption coupons, right? So right now in China, if I want to buy anything from digital goods to furniture, etc., I get 15% off. And where does the 15% off money come from? It comes from the government. So if I want to buy, so say recently, actually, I renovated my home. I bought, furnitures, right? Some of the furnitures are like cupboards, and other furnitures are like televisions, etc. They're just good. They would have cost me 50,000 yuan, but after everything, it only cost me 40,000 yuan. I saved additional 10,000, where I can spend the money on something else, right? And even if I spend the money on restaurants and on like buying additional digital goods that I don't usually use every day, I get another 15% off. So that's really good. It really boosted the spending of Chinese consumers. And also the government wants the people to enjoy a wealth effect, right? And so knowing that housing market, the property market still prices on the fall, what the government decided is say, hey, we want the stock market to be better, like the US, right? Where a lot of people invest their wealth into the equity market, and as the equity market rallied, you become more wealthy. That's the wealth effect, so you can consume more. So government also wanted to do that. They wanted a lot of the companies listed on the Chinese market are SOEs, right? State-owned enterprises. And the government just said, hey, I want you to boost your ROE. You to boost your dividend yield to make your company look more attractive, right? That's actually something, it's very similar to what Japan has been doing recently with, the stock exchange asking Japanese companies to make its corporate governance better to for those companies which are below 1 times PB ratio, and give me a plan, right? To get the your valuation back. For China, it was even more straightforward. The government stepped in and tell every one of its state-owned enterprises and tell them, hey, you know, boost your payout ratio, cut uh large businesses that doesn't make money, and boost your ROE, right? And that's your KPI. If you don't do it, I'll just fire your executives because all the executives, the main operating executives, like the CEOs, the chairman, they're all appointed by the government in SOEs. If you don't meet these things, I'll just fire you, right? So those are the things that they have been doing, and that's why we saw a dividend ratio, dividend payout rise, and dividend yield rise in Chinese stock market, and that's in the government's effort to boost returns in investment in the capital market and therefore to generate a wealth effect. So after all these policies, what have we seen, right? I mean, these are all data that are on the PPT. I'm not going to go through them bit by bit, but what we saw, just to sum up, is production has continued to recover moderately. Export is under pressure, but due to the tariff and the export rush effect, things are doing still okay in April, in May, and then we saw the growth rate of infrastructure, of household starts, of manufacturing investment to become relatively stable already in the first quarter and second quarter of this year. Um, so what we also saw is, after the first quarter, after the policy last year, end of last year, and this quarter, in the first quarter of 2025, um, we saw a stabilization and rebound in the profits of Asia-listed companies. And they're kind of in line with, all the economic growth data and performances that I just showed you in the previous two slides. So we saw a growth in the revenues of Asia companies, and we saw a growth in the net profits of these companies, and that has given a boost of confidence in the market. And so, beginning of this year, what we saw is the DeepSeek moment lifting up the sentiment of investors in China and globally. We saw a lot of money flowing into the AI market. They start to look at China. They think something has changed in China because of DeepSeek, right? And then as they invested, they then saw in March or in April in the first quarter that the data was good. The economic data was not that bad. It was steady. This rebounded. They saw a lot of companies' profits are actually growing year on year. So that kept those money in China. They didn't come in and just, bought up the stock market because of the DeepSeek and then they left, right? They didn't. There was things in China that's happening that kept the money in China. And these money these money are still making money till this day because a lot of companies are reporting strong earnings growth and they're having a good forecast of their earnings during their conversations with investors. And therefore, these money, previously probably hot money, fast money, but now they have more patience. They want to wait a little bit longer in China to see how long this may last. Because right now, I think, if you look at the Chinese market, if you look at Hong Kong, some good names like Pop Mart, etc. I mean, they've been on the rally and they're still on the rally. They're generating like year highs, right? And also, I think the third factor that's good was the long-term downward trend of the interest rate. And that's always favorable for the stock market because, it makes financing cheaper. It also makes, the equity valuation relative to, if you put the money into a bond market, right? If you put the money into buying Chinese government bonds or treasuries, then you realize, if the interest rate are coming off, or as low as they are today, or about 1.8%, you're not making a lot of money, right, by putting it into a bank. Whereas, given the DeepSeek moment, given the profit rallies and the stock market rally, you're probably making more money in the stock market. So relatively speaking, stock market has become more attractive versus, the treasury yield. And therefore we see, more money are happier to put their money into the A-share stock market to put it into the equity asset class. And so, given that the treasury yield, the 10-year Chinese treasury yield is coming off, and as I said, on the other hand, we saw an increase in the dividend yield of the Chinese companies, especially the SOEs, because the government urged the SOEs to increase their payout ratio, right? To increase their ROEs. So you saw two-side movement. One side where on the cost side, the treasury yield is coming off. On the other side, you see dividend yield going up. And therefore, right now, the dividend yield of the CSI 300 is at 3.35% on average. And, the treasury yield spread is at 1.7%, which means, by investing in dividend stocks, with a yield, which is a relatively stable yield, I'm making 1.7% more than if I put the money into treasury, or much higher if I put it into the banks, right, into deposit. And therefore, it's attracting more money, right? And another money that's being attracted is insurance companies, right? Because insurance, we all know for insurance companies, we have asset and liability, where on the liability end is the cost of writing all these insurance policies to the insurance policy holders, right? So if I'm a client, right, and I buy insurance product, they would say, hey, we'll give you investment return. And if something happens to you, we're going to pay out, right? These all have a cost, right? This is a cost of them, of their businesses. This is the cost of them writing that policy to you, right? And the cost has been relatively high in the past 3 years. It's like, 4% ish for the small medium insurance companies, and maybe around 3.6% ish right now for the whole sector on average. That's the cost on the liability side of these insurers, the cost of them running their business. And they want to make that cost back from investment, right? From investing in financial assets. But the investment return has been coming off a lot because, for example, the treasury, as I said, the 10-year treasury is less than 1.8% right now, right? And I put 70% of my asset allocation into that. So 70% of my asset allocation into 1.8%, and I only have 3%, 30% that I need to put into equities. And now my cost is 4%. Wow, that's really a big gap, right? Between, the cost and return. So what can these insurers do? They want to buy more equity assets. But we all know equity assets are very volatile, right? So if I buy into equity asset, I might making a lot of money today, but I might lose a lot of money tomorrow. And that's not what insurance wants. Insurance wants long-term stable business. So what kind of asset is the best for them? Now, recently, there is a change in insurance accounting policy where there is what we call an OCA account. If you buy an equity asset and you put that into the OCA account, you don't need to mark to market. You can avoid the volatility in the market. And therefore, for insurers, what's the best thing they do? They buy all these really good state-owned enterprise equities that pays out a lot of dividends, and they put that into the OCA account. They don't sell it, right? They just keep it in the OCA account, and they don't need to mark that to the market. There's no volatility. All they need to do is every time when they collect the dividends, they take the dividend into account, and that's the money they gain. That's their investment return. So they just make money on dividend yield. And that's been facilitating a good 4-5% on a lot of SOE names. So that's why they want to buy it, because that's much more closer to their cost profile. So that's what they're doing. So insurers are now the main buyer of dividend stocks in China, and hence that's why from a investment strategy perspective, I think that's something that you guys are all very interested in. From an investment strategy perspective, we now call upon a barbell strategy, where on one end, you invest your money, a good chunk of it, maybe 50 to 70% of your money, into this less volatile, high investment grade, more stable dividend stocks, right? They share some common uh, background, like their SOEs, which means their business is more stable, their credit rating is more stable, and they have good cash flow, right? And they have good payout ratio. They're paying high dividend. Dividend payout ratio is about 4-5% right now for the Asia companies, and that's where you put 50 or 60% of your asset in these high dividend stocks, and you just enjoy a nice 4-5% of dividend payout every year, right? And low volatility in the name. And then for the rest, 30, 20, 30, 40% of your equity into the three sectors that I just mentioned: new consumer, AI, and biotech, because these are under some structural changes. Um, New consumption. Well, what is new consumption? So, if we look back in Japan, back in the 1990s to the 2000s, right? As Japan's economy was affected, a lot of the youngsters, they don't spend the money in the traditional sense. They're not buying much, too much clothes. They're not spending a lot of money buying luxuries. They're not spending that much money on expensive dinings. They're not doing that, right? They're spending a lot of money on things they like, on hobby spending, right? On animation, on games, and on 2D cultures, right? That's where they're spending all the money. And that's similar with China right now at the moment. So a name that I've heard a lot is Pop Mart, right? Uh, a Chinese-based company, Labubu, what does it represent? It doesn't represent much. It's just like an IP, right? An IP figurine. Um, but there are cultures and emotions attached to it that youngsters like. And it's like a fashionable product. It's like a, a social intermediary, right? So people are buying these things. Um, they're not traditional goods. They're not something you eat, something you wear, something you consume. They're not like those traditional goods. They're just there to make you feel happy, right? And it's a sector that uh, that was never around before. But these companies are smart enough to find the demand in the economy and to roll out a product that meets these demand. And because there was nothing like it in the market, so they're getting all the money they can from people with that demand, right? Because they're like a monopoly in that sector. So Palma is like one of them, right? And then also we saw recently like Lao Pu, the Huangjing, right? The gold thing. They're also opening stores in Singapore. We never saw it previously. People using gold to make high-end jewelry, right? Because a lot of the gold that we make previously were like the traditional ones, right? Like you buy it at a gold cost plus a crafting expense, right? And that was a simple model, and you can craft it into whatever shape you like to represent whatever meaning you like. But they're more like commodities, right? Um, but what Lao Pu is doing is that they won't sell gold like Van Cleef, right? Um, they want to sell it like it's a fashion good. They're not selling the gold; they're selling the design. They're selling the brand. right? Like selling Cartier, right? Like if you look at Cartier, um, it doesn't mean apart from the cost of the gold or of the material, right? Uh, it also has a huge premium on top of the material cost. And what's that premium representing, right? It's representing the design. It's representing the moment that you're wearing a Cartier or Van Cleef, right? You know, the moment you go on the street, people will recognize you as being someone who's rich and who has a sense of fashion, right? And that you are, you know, it represents you as a person, um, having a very high social status. So what effectively is selling is a social status, right? But gold wasn't doing that because, although gold is expensive, but, they've never been selling designs. But Laopu is doing that. They're telling you, we have three, four series, designs that are unique to us. The moment you buy us and you wear it, people will realize, oh, you're wearing Laopu, right? And they'll know that Laopu has a premium on its brand, has a premium on its design. And you must be a very high social status person in order for you to buy Laopu because you're buying something with high premium, right? So this is like the new consumption stories that I have in China. So apart from that, we're also looking at companies like Spore, which is like, selling heat not burnt smoking products in Japan. We're also looking at Brook, which is a toy that is selling to like kids, like in schools. And these toys are like the new social currencies in schools, right? Every kid plays with it. Like it's like trading cards, right? Every kids play with it. They collect it, and they exchange it. And if I have it, you don't, then I'm like I'm a I get to show off, right, in schools. So these goods are the new consumption goods. And the AI, of course, is like, DeepSeek moments, right? So AI tries to catch up, DeepSeek is happening. And so a lot of money is buying AI Chinese applications. They think, China is neck and neck with the US and they'll be the next one who will come up with new AI products and that will change the business models of all the companies in China. And then the next big thing, right? And right now they're still quite cheap. And then biotech. What's happening in biotech is recently, I think um, there's a few large conferences out there, like the ASCO academic conference. And what we saw previously is Chinese biopharm companies. Um, what they're doing is just called fast follow, right? So whenever there is a innovation in the US, we fast follow it, right? It's like engineering, as I said, with DeepSeek, right? Where we're like engineering everything we have and we want to produce it, but cheaper, right? That's what we want to do. But in ASCO, in this academic conference, what we saw is a lot of the Chinese companies has with the US FDA, they've came up with first in class and best in class uh, drugs, right? Which means they're again neck and neck with US again. So this is like a deep seek moment in biotechnology where Chinese pharmaceuticals, biotech companies, they're no longer following and just producing things cheaper, but they're coming up with better products, best in classes and first in classes, right? Things are like innovative and does better than their US counterparts or their global counterparts. And because of how good their product is, um, during those conferences, a lot of foreign pharmaceutical companies have reached out to these biotech companies in China and say, we want your product. So they're doing a lot of licensing out, right? And that's like an industry recognition from the top tier industry experts saying, the Chinese biotech companies, your technology is good. We want your technology and we're happy to pay money for it. And then we want you to license me these products and I'm going to do business development, the BDs for you globally. Because with these companies in the US, in Europe, they're facing another issue where a lot of their patents are coming to a expiry, and they have not much new products in their pipeline after this patent cliff. right? So all of a sudden, their patent will suddenly fall like a cliff, and they don't have much patent protection, and they're very worried. And now see these first-in-class and best-in-class um, biotech, products in China. They want to sign a deal and to quickly uh, get the licensing out so they can expand their patent periods and their patent pipelines to protect themselves. So that's what they're doing. And so in biotech, we are running into a deep seek moment where the Chinese biotech company all of a sudden, after 3, 4, 5 years of low key development, all of a sudden their products matured, their research and development paid off, and now they're in the market in these academic conferences and telling the rest of the world, we're now in tier one. We're now net competition with the best of the best in the world, and we have products that are first in class and they're best in class. And that's a deep sea moment. And so these three sectors, new consumption, AI, and um, biotech, are the three sectors which I think there is structural opportunity. And I think they're all undergoing something very similar, which is globally, they are out, they're coming out, and their products and their branding and their technology is in the first tier class, world class, best in the world, and they're all flourishing, right? And that's exactly what the government wanted, because during the late period of Donald Trump's first presidency, the government realized what Donald Trump wanted to do. He wanted a trade war with China. He wants to pressure China, right? He wanted, everything to come back to the US. And so the government said, all the companies in China, I don't want you to follow and to copy, because if you just follow and copy, what Donald Trump do will just kill you all, right? I want you to innovate. I want you to lead the industry. I want you not just to sell these things in China. I want you to sell it globally to the whole world. I want you to go overseas. And so if you look at these three sectors that I just talked about, they're all innovative. They're all first or the best in the world. Very good product, very good branding, and they're selling it to the whole world. And that's why I'm thinking the best strategy that we should approach with the Chinese investment right now is to have a Chinese dividend stocks on one end. That gives you a very good fixed return of 4 to 5% annualized. And if you look at ROE, right? If you look at the capital gains, it's actually 11 to 12% for the past 5 years, versus the SPX, which is 14, 15%, about the same. But the volatility, the max drawdown is much, much less. It's only about 12 to 13%, right? Versus the SPX 35%. So that one on one end. And on the other hand, you should invest in consumption, the new consumption, in AI tech and in biotech names in China. And that gives you an option or booster, an earnings booster, because they're more volatile, right? So you buy low, buy cheap, and then, it gives you good optionality and gives you a boost in your returns. And that would be my recommended strategy. So Darren, this is my presentation. And I hope I've made myself clear, and I hope it's helpful to the retail clients here at Phillip Securities.
Thank you, Mr. William. I'm sure everyone has a lot of new ideas now. I'm sure you understand a lot more, okay, about how the US and China, they're all going to tie in. You understand a lot more about the leading sectors that Mr. William was talking about: biotech, AI, and new consumption. Okay, so these are some of the key points. And also, he talked about something called the barbell strategy. So, before I continue, so everyone can see my slide, right? Can you all just put like a 1 so you can see, because we were facing some issues earlier. For those of you, okay, yeah, thank you. Okay, so you can see my slide. Okay, so I just want to talk about now, since we want to be actionable, we don't want to just know. Okay, so how can we do this? But first, so just a quick summary. So why do you want to look into China markets now in the second half of 2025? So for starters, is if you are engaging in value investing, then the CSI 300 is actually currently trading at the P and PB ratios are currently at the lowest they have been in like almost a decade. Okay, so if you, this will mean to the value investors that if you're buying, you are buying into the second largest economy of the world at a discount. Okay, markets also tend to revert to their historical averages over time. So if the Chinese economic fundamentals stabilize and improve, as what we went through, Mr. William went through earlier also, these deeply depressed valuations could lead to a significant capital appreciation for you. Okay, so understand some people are still hesitant. So earlier on, we went through China's policymakers also, they have signaled a pivot towards a pro-growth stance. Okay, so we can expect more targeted monetary and fiscal stimulus as well. Okay, so you want to stay on the lookout for all this. Okay, I just want to quickly wrap up with let's see how a lot of these have already been covered earlier. So I just want to quickly wrap up. Okay, so despite the short-term dysfunction that it was facing in the past, okay, China's long-term trajectory as a major global economic power, it still remains intact still. Okay, and even in this trade war climate, investing now is about positioning for that long-term potential. Okay, especially when it's being offered at a discount. Okay, so even for me personally, I've positioned part of my portfolio into EVs. Okay, and their supply chains like battery production. Like recently, if you are following, CATL was listed on the Hong Kong Stock Exchange, and it's available on the Stock Connect, so you can get it as well. Okay, so however, okay, Chinese stocks should be part of a diversified portfolio as well. Okay, cheap doesn't mean risk free. They can be highly volatile as well. So I would like to present a way for you to get allocation for Chinese stocks into your portfolio by way of investing into ETFs. Okay, so let me just go on. Okay, so let's talk about 515080, the China Merchant CSI Dividend ETF. Okay, I want to skip all through all the little like the yield and all this and just go dive right into the specifics or why is this here. Okay, so this ETF actually achieves a higher yield due to the strategy, okay, which is great for the income focused investors. So this strategy is the key. Okay, is weighted by dividend yield, and it focuses on consistency and value as well. Okay, so remember everything that I said so far regarding the policy tailwinds, such as the Chinese government's push for state-owned enterprises or SOEs, that's what Mr. Winner was referring to earlier, to improve the shareholder returns through higher dividends. So this ETF will directly benefit from that. And as many of the high yield A shares are those large, stable SOEs with strong cash flows, they are now being so-called encouraged to pay out more to shareholders. I think earlier on we had a very raw version of it. If you don't pay out more, I'll fire you, that thing. Yeah, so basically they're being encouraged to pay out more to shareholders. And the high dividend yield strategy like this usually is a little bit more defensive in a volatile environment, and it focuses on companies that are already mature and returning capital to their shareholders. Okay, and now bonus with lower valuation as well. Okay, so if you see the focus sectors, you see like manufacturing, financials, energy mining, transport. Okay, these are essentially like foundational cornerstone sectors in the Chinese economy, and are often also dominated by these cash flow rich SOEs that we were talking about earlier. Okay, so the top three companies, Costco, Zizhong Energy, HLA, some people are knowing it as Heilan Home, okay, are examples of these established companies with stable earnings. Okay, so so I don't want to go through. So for all of, I've only recently started having exposed to these to the China Hong Kong market as well. Okay, so for all of you who are underexposed, you're looking for like some contrarian moves, like we talked a lot about US just now, or a dividend focused ETF like this can offer a good exposure. This basically offers you a good exposure to the value from China. Okay, so don't want to spend too much time on this. You can just take a look, 5080. Okay, so I'm just going to move on to this. Okay, so if you're not, let's say you're not solely focused on income and maybe still looking for a strategy that can kind of outperform the broader market while still being in China's undervalued growth, we can take a look at another option here. Okay, for those of us who are, you're more growth oriented, because we spend a lot of time talking about growth. Okay, the growth of China market, the long-term trajectory. Okay, so you're looking to outperform the broader market. I want to introduce you to the China Merchants CSI 300 Enhanced Strategy ETF. The ticker is 561990. Okay, skipping through the yield and all this again because you can find all this data online as well. Okay, I don't need to show you here. Okay, so the key difference, of course, would be that income is not the primary objective. This ETF looks kind of more towards the total return and capital appreciation as well. So the key difference here is the enhanced strategy itself, the thing this thing they're talking about. Okay, so unlike those purely passive index trackers, okay, this ETF is like it employs something called multi-factor approach that you can see. I put down the strategy, multi-factor. Okay, so you're wondering what value trends, and let me get to that. Okay, basically, it's a quantitative method, okay, to select stocks from the CSI 300 universe that show certain characteristics, such as being undervalued, hence the value, okay, a positive price momentum, okay, hence trend, and having an improving market sentiment, okay, hence sentiment, okay, value trend, sentiment, okay. So this will allow it to, if those of you who look into like quantitative kind of investing, okay, this is the quantitative alpha where they aim. So they mean to seek to generate returns above the passive CSI 300 index, okay, that then you will normally deliver basically. Okay, you can read more about quant strategies online as well. Okay, and those of you who are more seasoned, you know what I'm talking about. Or not say more seasoned, but like if you use quant strategies, then this is kind of what it is. Okay, so okay, the focus, I thought about the focus a little bit. Okay, so why this is growth? Okay, so this is in general, it is broad market, blue chip stocks. And as you can see, the top three holdings are with names like Moutai, the liquor brand, okay, CATL, which is contemporary Amperex, okay, the global leader in EV batteries and technology, and Ping An Insurance. Earlier on, Mr. William also spoke largely about insurance as well. So Ping An Insurance is here as well. So these are all high quality, large cap companies that represent in significant segments of the Chinese economy, okay, and selected in this ETF as well. So if you're looking to capitalize the potential for significant capital appreciation and diversify your portfolio into some growth and aiming for this alpha, then this ETF is offering an option. Okay, so I'd like to go into something. Just now we all heard about the barbell strategy. Okay, so we've already looked at two ways to gain exposure to the China market through ETFs. One is focus on high dividend income, and the other is on, and the other is on capturing growth. Okay, so now the wonderful, beautiful thing about having these two options is that you don't necessarily need to choose just one. Okay, we'll move into the barbell strategy. So basically, if like the barbell, they have weights that kind of balance each other out. Okay, but the weights have like different weight to it. So like there's a 10 plate and a 5 plate and a 5 plate and things like that. So you can kind of like, in the end, it balances out, but it's not like 50-50. Okay, so this is how you work it out. Okay, so on one end, we have an income anchor. Okay, and the other end, we have a growth pursuant ETF. Okay, so 5080, it covers all your SOEs, your banks, and your energy. Okay, so the kind of the foundations of cash generation. Okay, and then the 561990 that we just went through, okay, covers this dynamic tech sector and all these other blue chips. Okay, providing wide coverage. Okay, this is extensive coverage. So now you can roughly see how this works. So you just take a look at this summary table here. Okay, yeah, you can grab a screenshot or something of it. Okay, so you can find you can kind of use a combination to build a portfolio that kind of captures both the defensive income and the growth potential of these companies. Okay, and don't forget earlier on we spoke about this as well. Okay, both of these parts of your barbell strategy are going to be elevated and pushed by strong policy support from the government. So be it the SOE push for the dividends and the payouts, okay, or broad measures that were going to stabilize growth and encourage innovation. So all of us who are underexposed, okay, this could be the way for you to start this barbell strategy. Okay, so before I wrap up today's session, there's something interesting that I feel. In actual fact, I believe that because Mr. William gave me this information and now we're sharing it with you, this is also, you're probably like the first few people to know about it as well. Okay, so on the 30th of this month, there is a very good chance, okay, the Hong Kong Exchange will be reviewing the ETFs that you'll be including in the Stock Connect. Okay, so there's a high possibility that two more ETFs that might be listed, okay, and they can fit your needs. Not listed as in like they are new, but more like you can trade it through the Hong Kong Stock Connect, which is of course very important for us who are outside of mainland China. Okay, so the China Merchant CSI A500 ETF, okay, as the name suggests, okay, and then the China Merchant CSI Hong Kong Tech ETF, okay, both of these are focused on capital growth as opposed to earlier, okay, you can just grab a picture of this, you know, and look out for it, okay. However, you have to note that these two are different in that they can also complement each other or the ETFs that we mentioned earlier. Okay, so for starters, the A500 ETF is a broad market, you know, core holding, okay, that is all spans across a wide array of industries. Then the Hong Kong Tech ETF is a thematic sector thing. Okay, so together these two address different needs. Okay, but so like the A500 can be used for foundational allocation, and the tech can be used for like tactical. You know, you want to get into tech now, and you know, jump in on the volatility or jump in on the growth. It depends on your strategy. Okay, so we can also combine them earlier with the 515080 and the 561990 to achieve this broad combination balance of like income and growth thematic exposure in this very nice barbell strategy. So yes, that would be, but as always, of course, do carefully consider if this fits your investment needs. Please consult with our financial advisors if you are unsure this aligns with your investment objectives and risk tolerance. Okay, so the time is actually 8:17. We've actually overshot quite a bit. So before we end, I would like to just talk about, okay, if you're not a client yet, I encourage you, get the Poems Mobile 3 app, join our communities. There's a whole lot of information there for you. Okay, just grab a screenshot, scan the QR code if you're on desktop. Okay, I don't want to linger too long and keep everyone. Okay, so we have a lot of things. Okay, just basically options trading, global markets. That one is run by my team as well. Okay, we got technical analysis. It's free and it's a real guy. It's not like AI or something. Okay, it's one of our research staff who specializes in technical analysis. Sometimes you even take requests and things like that. Okay, we got earnings calendar results. We got ETFs as well. Okay, and yeah. Okay, so Poems Mobile 3. If you're an existing client using Poems Mobile 2, you might want to consider upgrading to Poems Mobile 3 to enjoy our communities, as well as all the new features that we are coming out for it, and gamification as well, little quests that you can play to get coins and exchange for rewards. It's all available here. Okay, and for those of you who already have it, and you're thinking, hey, maybe what's one more community? You can join our Telegram community as well. Okay, that is this one here is run by my team. Okay, we have daily updates. Sometimes we have polls. Sometimes we have extra news. You know, we answer questions there for you as well. Emergency news, everything is there. Okay, so this one you can just scan, join us. Okay, and some of you came from our Telegram channel as well when I told you that we were actually having this webinar today. So thank you. I will see you on the Telegram channel. Okay. And of course, if you're not a client, do consider opening an account, grab a screenshot. Okay. Head to poems.com.sg to find out more about us. Okay. So before we end, uh, I would just like to get Mr. William back with us. Okay, Mr. William, we have some questions Uh, we have some questions. Maybe Mr. William, you could just choose one question to answer before we end.
Uh, yeah, there's quite a lot actually. Maybe two questions, I think. Will be quite fast. So one is, what are potential pick and shuffle stocks for China AI? I think a lot of them are in Hong Kong. To be fair, I think if you want something long term that you can do pick and shuffle, and you know that it won't go bust, and it can, it profits the most from AI growth, it will be Alibaba and Tencent. They're the two large companies that are at the forefront. They have a lot of capital expenditure towards AI, and they have all the flows, natural flows that goes on their platforms, so they don't need to spend a lot of money and cost buying those flows. So whenever they roll out AI function, right, they can just put it on their softwares or applications without you noticing it, and they don't need to spend a lot of money publicizing it, right? Because you will notice it and you'll use it straight away. And they also have spent the most money in terms of building AI infrastructure and building AI cloud, right? So they're big companies. They're a bit like the US version of Google and Amazon and Meta, right? So they're the forefront of that. But if you want something small with a lot of volatility, but can goes up a lot, but on the downside it also can may come down quite a bit. Is like Jin Cloud, right? Jin Yuan, or like uh 万国数据, right? Those names are they're quite volatile, but whenever the wind comes and the money starts to shift towards AI, these days they rally a lot. But the problem with them is that fundamentals are not as solid as Alibaba and Tencent. And a quick second question, I think, is with the very high yield, could there be risk of value traps in the Chinese market? Um, I'm not too sure what you mean by very high yield. Do you mean like a low P ratio, or do you mean by high dividend yield? So in China, there's two types of stocks, right? One is growth, and one is the SOEs that are more value names and dividend. With the value names, you don't need to worry too much because they're all SOEs. The government makes sure they make money. There are a lot of time monopoly in their own sectors, or maybe not monopoly, but like oligopolies. They don't go into price war with each other too much, and they're more potentially more regional, right? So they're not direct competitors with each other, and therefore they have a very good natural resource. They're monopoly to that. Their business is more stable because they probably deal with the public or deal with a lot of other SOEs, and have a strong pricing power. They have very good cash flow. So, with this name, you're not trying to expect to make a capital gains. You're not trying to make a lot of money from the rally. What you're trying to make is every year they pay out, a good 5% every year, and well at the same time maintain their stock price, right? So that's what you're expecting. But recently, there is also a capital gains opportunity. Now, I don't think it will last forever, right? But at least I can see for the next 2 to 3 years, there will be capital gains opportunity on these high dividend yield names because, as I said, the insurers are buying, and the insurers will continue to buy them because every year they're writing out new policies, and every year they're under huge pressure to cover the cost of these new insurance policies that they wrote. So every year they need to buy more and more of those high dividend yield equity names. And because of their pressure, not only for new insurance policies that they need to buy more these dividend names to cover their costs, but for their existing policy that they already wrote out 5, 10 years ago, because there's a duration mismatch in China where a lot of the insurance policies they're for 10 years or longer, but you don't have much 10 years or longer products in China, right? Apart from government treasuries, there's not a lot of assets that you can invest in China that offers you such a long duration. So maybe every 5 3 years, 3 5 years, their previous investment has expired, and they need to invest that money into something new, and they find the investment return is coming off, right? Which means they then need to devote more of their existing assets on the existing, the existing assets based on the insurance policies that they already sold 10 years ago, right? These assets, they need to reinvest these. And they, in order for them to match the cost of these policies 10 years ago, which is really high, like 5, 8%, they need to put that money into more risky assets. And therefore, they will be putting more money into these high dividend yield names because they are risky asset, but they're the less risky ones. And under OCI accounting rule, they're not volatile and mark to market. And that's why insurers love these names. So more money will flow into dividend. That's for one. And the second thing, if you're talking about the growth names and whether there is a valuation, kind of like a trap, then I'm telling you this: buy the structural names, right? The ones I just said. If you're in high tech, EV batteries, if you're in EV vehicles, if you're in like AI, in new consumption, in biotech, these are the sectors that you should go in when they're cheap. And that's important when they're cheap because biotech has rallied a lot. And right now I wouldn't say it's a good time to buy, right? So watch out. So for those names that has rallied a lot, wait for it to come off a little bit, right? Because there's a lot of things in the world that may let it come off. If Donald Trump comes up with a policy, or if there's like something happens in the Middle East, stock prices come off, that's when you go and pick these names. And these are very good growth names because they're really growing their profits, right? They have good products, they're expanding their products, they're expanding their network, they're going overseas. PopMart, it's probably crazy here at Singapore already. These names are growing like 100% every year, right? So you can buy them when they're happening. But of course, when you go into these names, be careful because, maybe when their cycle ends, they'll come off, right? But at least I think, within these sectors, if you buy them cheap, then there's not much risk of them coming off, and then you can ride on the structural growth of these sectors. And with structural growth, I don't think that's a value trap. Yeah. So that's Darren. Those are the two I'm replying right now.